All right, let's talk about the US dollar. It's one of the most powerful and honestly most misunderstood forces in the entire global economy. We're going to get to the bottom of its strange, almost magnetic power, especially when the world seems to be falling apart. So let's just jump right into the big paradox here. Whenever a crisis kicks off, whether it's financial or geopolitical, what happens? Global capital doesn't flee the world's largest debtor nation. No, it runs straight to it. So why? What exactly makes the dollar the ultimate financial shelter? That is the mystery we are unpacking today. First things first. If we want to understand the dollar's power, we have to figure out what strong even means in the world of currencies. And trust me, it's not nearly as simple as it sounds. Okay, let's get a core concept down. In the foreign exchange or FX market, no currency has a value all on its own. It's all relative. A dollar is only worth something in terms of how many euros or yen or pesos it can buy. And this simple fact, well, it creates a bit of a puzzle. Exactly. This is the fundamental problem that traders and economists wrestle with every single day. If the dollar is moving in opposite directions against different currencies all at once, how in the world do you get one clear picture of its overall strength? How do you answer that simple question, is it up or down? So, how does the market even try to solve this? Well, to get that big picture view, they rely on things called indices. You can think of them as a weighted average of the dollar against a whole basket of other currencies. And this is the most famous one of all, the US Dollar Index, or DXY. You hear about it on the news all the time. But just look at its makeup. Over half of its weight, a whopping 57.6%, is tied to a single currency, the euro. In fact, the whole thing is overwhelmingly biased towards European currencies. And here's our first major clue in this investigation. The DXY was created way back in 1973, and its structure has basically been frozen in time. It completely ignores some of the US's biggest trading partners today, like China and Mexico. It's like trying to understand modern internet traffic using a map of the 1970s telephone system. It just doesn't work. So here's the crucial point. There is a much better tool out there. The Federal Reserve has its own index, called the Broad Index, and it's way more sophisticated. It tracks the dollar against 26 of America's actual trading partners, and it updates the weightings every single year to reflect reality. So while the old DXY can spike like crazy just because of something happening in Europe, the Broad Index gives us a much smoother, much more accurate picture of the dollar's true global strength. Okay, so now that we know how to actually measure the dollar properly, let's get to the real engine behind its power, its unique status as the world's ultimate safe haven asset. Let's play out a scenario. Imagine it's early 2026. A major geopolitical crisis explodes onto the scene. Let's say the Strait of Hormuz gets shut down. Panic rips through the markets. Global supply chains are in chaos. So what happens to all the money sloshing around the world? This right here is the core mechanic. It's a simple, three-step dance that happens every time. Step 1, crisis hits. Step 2, huge investors. I'm talking central banks, sovereign wealth funds, the big players. They dump their risky assets. They are all looking for the safest possible place to park their money. And that place is U.S. government debt, also known as treasuries. But, and here's the absolute key, step 3, you can't buy U.S. treasuries with euros or yen. You must buy U.S. dollars first. And it's that sudden, massive, desperate demand for dollars that sends its value through the roof. This quote just says it all. The dollar's safe haven status isn't just some old story or a vague sense of trust. It is a hardwired mechanical link. Think of it this way. The U.S. Treasury market is the only door to true safety in a global panic, and the dollar is the only key that unlocks it. So what about the other contenders? How does the dollar stack up against its main competitors for that safe haven crown? Things like gold and Bitcoin. Well, their behavior in a crisis is very, very different. Let's break this down real quick. The dollar gets stronger because of that mechanical rush into treasuries we just talked about. Gold? Yeah, it often rallies too, but that's based on pure fear. Its big weakness is that it pays you nothing to hold it. When interest rates are high, U.S. treasuries offer you a risk-free yield, which makes them way more attractive. And Bitcoin? Well, despite the whole digital gold story, the data shows that in an initial panic, it tends to get sold off hard, right alongside high-risk tech stocks, as investors just scramble for cold, hard cash. So, putting this all together, what does it mean for the future? Well, the dollar's path from here on out is basically a giant tug of war between two massive opposing forces. On one side of the rope, you've got all the forces pulling for a stronger dollar. As long as there's geopolitical fear and conflict in the world, that safe haven demand we've been talking about will keep the dollar propped up. But on the other side, you've got some serious economic headwinds for the US. We're talking massive government deficits and, importantly, the real possibility that the Federal Reserve will start cutting interest rates. And that brings us to this key idea, the checkmark pivot. See, if the US economy starts to slow down and the Fed has to cut interest rates, the yield on those super safe US treasuries will fall. And that makes holding dollars a lot less profitable compared to other currencies, basically erasing its main advantage. If that happens, the market's focus could suddenly snap back from all that geopolitical fear to the underlying economic fundamentals. And that could trigger a really significant drop in the dollar.
So what should you actually be watching? 3 things. First, geopolitics. If the world suddenly gets a lot calmer, that fear-driven demand for dollars is going to fade. Second, U.S. economic data, especially the job market. Any weakness there is the main trigger for the Fed to start cutting rates. And finally, Fed policy itself. The bigger the gap between U.S. interest rates and rates in the rest of the world, the stronger the pull of the dollar. If that gap starts to close, the dollar's appeal really starts to fade.
And that leaves us with the big question, doesn't it? Is the dollar's incredible, outsized power a permanent structural feature of our global financial system, all thanks to the unique role of the Treasury market? Or is it mostly just a side effect of a chaotic and fearful world, one that could fade away if and when stability ever returns? The answer to that is going to define the global economy for years to come. Thanks for tuning in.